Well, we're really looking at two Senate bills right now. One is the one that Chairman Hatch unveiled last Thursday, and the second is a modified version he released on Tuesday night. Both in his original bill and in the revised amendment that came out on Tuesday night, Chairman Hatch holds to a 20% corporate tax rate effective January 1 of 2019. That's in contrast to the House bill, which proposes to lower the corporate rate as of the beginning of next year. Like the House bill, the Senate proposal calls for moving to a territorial tax system with a one-time transition rule to allow old E&P to be moved back to the U.S. At lower rates than in the House package. Like the House bill, it has a variety of proposals labeled loosely base erosion to prevent the U.S. tax base from being eroded by companies shifting U.S. income into overseas locations, and a variety of changes on the individual side that lower marginal rates and take away a variety of credits and deductions to pay for it. The biggest new thing we see in the Senate package was unveiled by Chairman Hatch in his Tuesday amendment, which is to include in the bill a repeal of the ACA's mandate that all individuals buy health insurance. For procedural technicality rules, they can't repeal the mandate, but they reduce the penalty to $0, effectively gutting the mandate. That creates more revenue available for tax reform. That is a major change in the Senate bill over what we've seen coming out of the House, and is likely to be a flashpoint for discussions going forward. So consistently, we hear lots of questions. What will this mean? Will it happen? Asking for technical advice, how these provisions might be implemented. We see lots of companies engaging in scenario modeling and planning that helps them look at their company's profile to understand what tax reform might mean to them. So we see some companies engaging in the kind of forward-looking planning to be in the best possible position to deal with the fallout from reform. Sort of a variety of things companies are doing. I think a lot of them are obviously educating their C-suite, like CFOs and CEOs are asking questions of the tax function. The tax function needs to have answers for them. So for multinationals, I think that in the short term, it's how will I manage the tax due on bringing back earnings and profits under a transition tax in the short term. In the long term, there's transition issues related to the base erosion measures that are pending in both bills. The House package as introduced would be quite burdensome on companies making payments to related parties abroad. The Senate proposal is a little bit less aggressive, but still would be require many companies to think quite novelly about how they structure their global supply chains. For domestic corporations with mostly U.S. operations, they have to think about the impact of a lower tax rate, what it means for their deferred tax assets or deferred tax liabilities, and also think about what are the tax benefits they'll be giving up to get that. So for example, many domestic companies in the manufacturing space are able to claim that what's known as the 199 deduction for manufacturing income. That's almost certainly to go away if reform is enacted. And so they need to think about, what's the puts and takes of a lower corporate rate versus the deductions and credits they're going to give up to get there. Well, I think there's always the opportunity to do end-of-year tax planning. So if you live in a high-tax state, you might want to prepay some state taxes this year in advance of 2018 when state and local taxes may not be deductible. The House bill proposes to repeal the estate tax after 6 years. The Senate bill just doubles the estate tax exemption. I think if we see a bill enacted this year, the Senate approach of doubling the exemption rather than full repeal is more likely. So the Senate approach on pass-throughs is a little different than the House approach. The Senate would allow pass-throughs to deduct about 17.4% of their income if they're a qualifying pass-through, which creates an effective top rate under the Senate structure of about 31%. The House approach is a little bit different. It allows you to pay a 25% rate on qualifying income. There's a complex test to see how much of your pass-through income qualifies for that 25% rate. There's probably not a company in America this bill doesn't affect. And I would say that's true also about nonprofits, educational institutions, individuals. If this is enacted, there's nobody in America who's going to say business as usual. Two pieces of advice. One, stay educated. Number two, be nimble. This is going to be a very volatile 2 or 3 weeks in Washington. Companies that are sort of caught flat-footed will be disadvantaged, so stay alert as to what's going on in Washington. Be prepared to take actions to put your company in the best possible position to either take advantage of or minimize the disruption of tax reform.